Welcome to another FAR walkthrough video. I'm Logan, and in today's video, we're going to be talking about preparing a statement of cash flow using the indirect method. And we're going to be doing that by diving straight into the questions, which is the Superfast CPA approach. If you don't know much about our strategies, make sure you go to superfastcpa.com and check out our free 1-hour webinar training. We go over the key ingredients to passing the CPA exam. And again, it is only 1 hour, it is free, and we will show you how to be effective and efficient with your studying so you don't lose any time. Also, just letting you know, we will only be going over 9 questions in this video, whereas Superfast CPA members will have access to the full 18-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a Superfast CPA member. With all that said, let's dive straight into the questions. All right, here we are at question 1, and as we dive into these questions, I just want to point out, yes, this video is bigger than usual. That's because this is a huge topic, the statement of cash flow. I know a lot of people struggle with it, especially with the indirect method when it comes to operating expenses or operating activities. So I decided to make a lot more questions this time because I think it's something that a lot of people need help with. So we're going to dive into the operating cash flow, we're going to dive into the investing cash flow, we're going to dive into the financing cash flow, and a little bit about the disclosures as well. And with that, let's dive into question 1. You are given the following information for ABC Corporation. Net income for the year, $150,000, depreciation expense, $25,000, increase in accounts receivable, increases in accounts payable, decrease in prepaid expenses, and loss on the sale of equipment. Using the indirect method, calculate the cash flow from operating activities. So again, there's 3 different cash flow activities. There's operating, financing, and investing. And probably the most confusing one is using the indirect method to calculate operating cash flow. So let's dive straight into this question to start learning what the indirect method even is and how it works. All right, the answer is B, $175,000. And this is a big explanation because I wanted to dive into the operating cash flow a lot before we get into anything else. So let's walk through this. To calculate the cash flow from operating activities using the indirect method, start with the net income and adjust for non-cash items and changes in working capital. So you start with the net income and make adjustments from there, and that will give you the operating cash flow using the indirect method. So you take the net income, you adjust for non-cash items, and we'll talk about each of these, by the way, in more in depth. So you add back the depreciation expense, and again, we'll talk about why you do that. You add back the loss on the sale of equipment, and then you decrease the cash flow based on the increase in accounts receivable. You increase the cash flow based on the increase in accounts payable, and you increase the cash flow based on the decrease in prepaid expenses. And some of that might be like, why would you increase or decrease the cash flow because of that? That's what can get so confusing with the indirect method. So let's dive into each of these to understand. For the depreciation, why do you add that back? Since depreciation is an expense that reduces net income without affecting cash, because depreciation, again, is just you're depreciating the asset, but money's not actually leaving your account because of that. We add it back to net income to reflect the true cash position. So that's why we start with net income, and then we add back or take out anything that did or didn't affect cash. The loss from the sale of equipment is added back because, again, this reduces net income without affecting cash. So because there was a loss on net income, that decreases the net income. But did cash actually leave the account because of the loss? No. So that's why you add that back to get the true cash flow. An increase in accounts receivable means that the company made sales on credit and hasn't received cash for those sales yet. This represents a use of cash, so we subtract it from net income. A decrease indicates that cash has been collected from previous credit sales, representing a cash inflow, so we add it to net income. So again, another thing that might be a little bit confusing, but it makes sense if you think about it. If accounts receivable increases, that means that the income increased, but you didn't actually receive any cash yet because you still have yet to receive the cash for that income. So as far as the cash flow is concerned, the net income is artificially increased when it shouldn't be. So you decrease the cash flow because there was an increase in accounts receivable, and then it's the other way around. When accounts receivable decreases, that means you received cash. So even though the income was already recorded, you're increasing cash because, again, you received cash from those accounts receivable. Now, as far as accounts payable, this means that the company had more unpaid bills if it increased, indicating that it hasn't yet paid cash for these expenses, which, as far as the cash flow statement goes, that's an increase. That means you haven't had to pay money yet. That's a good thing. This represents a source of cash, so we add it back to net income. And then if there's a decrease in accounts payable, that means the company has paid off some of its bills using cash, so we subtract it from net income. So again, some things that could be a little bit confusing, but when you think about how they actually affect cash, that's the idea behind all this. what actually happened for the cash from these different transactions. Let's talk a little bit more about the other things. So I'm going to scroll down here. And finally, for the prepaid expenses, a decrease in prepaid expenses means that expenses paid in advance are now being recognized without needing additional cash payment. This represents a source of cash, so we add it back to net income. And increase means cash has been used to pay expenses in advance, which reduces cash flow, so we subtract it from net income. So again, with the indirect method, a lot of things are kind of backwards from what you might think because it's only coming from the perspective of how did this affect cash. So accounts receivable going up decreases the cash flow. Accounts receivable going down increases the cash flow. Accounts payable going up increases the cash flow. Accounts payable going down decreases the cash flow. Again, it might seem a little counterintuitive, but that was the intro. So we're going to do a couple more questions on operating cash flow to get you a bit more practice. All right, here we are at question 2. You are given the following information for XYZ Corporation. Net income for the year, $200,000. Depreciation expense, $30,000. Impairment loss on equipment. Dividends received. Increase in accounts receivable. Decrease in accounts payable. Increase in trading securities. Using the indirect method, again, calculate the cash flow from operating activities. So we saw a lot of this before. Maybe pause the video and think through what we just talked about and see if you can think through what would affect cash and how it would affect cash and see if you can get the correct answer. Come back when you're ready and we'll look at it together. All right, the answer is D, $218,000. So we're going to walk through this again, trying to get you lots of practice here. To calculate it with the indirect method, you start with net income. You add back the depreciation expense because on the income statement, that decreased income, but no cash actually went out. So you have to basically add it back to get the correct cash flow. You add back impairment loss because, again, that's a loss that decreased net income, but no cash actually was lost from that, so you add it back. Now, for dividends received, this does not require an adjustment because if you think about it, this was already included in net income, and this is cash that they actually received. So since it's already a part of net income and we're using the indirect method, you don't need to make an adjustment for that. But technically, it is a part of operating activities because you don't take these dividends received and recognize the cash flow in any other part. Now, again, as far as the increase in accounts receivable, that decreases the cash flow because you got income without actually getting paid. So you didn't actually get cash for that yet. And then decrease in accounts payable, that means that you paid off your debt, which means, again, you used cash to pay that off. So that's $12,000 less there. And then an increase in trading securities. Again, you're using cash to buy those securities, and so that decreases your cash. So all that together, the net income plus the depreciation expense plus the impairment loss, less the increase in accounts receivable, less the decrease in accounts payable, and less the increase in trading securities gets you $218,000. And again, you have to think about this. How does this actually affect cash? So if that made sense to you, that's great. If not, maybe again, pause the video and kind of look at these explanations and also think about what I just said. And we're going to do one more question on operating cash flow. So let's go to question 3. All right, here we are at question 3. This one's a little bit more straightforward, but it goes to show you kind of how you have to think about the indirect method sometimes. You are given the following information for DEF Corporation regarding its utilities payable account. So you have the beginning balance of the utilities payable of $10,000, you have the utilities expense for the year of $35,000, and you have the ending balance of utilities payable at $8,000. So we have to calculate the cash paid for utilities during the year. So how much did you actually pay for utilities based off of these amounts that we're seeing right here? It's pretty straightforward. You could probably figure this out on your own, but if not, that's okay. Let's go to the answer. All right, the answer is B, $37,000. And again, this isn't too complicated. You take the utilities expense plus the decrease or the increase in utilities payable, and that gives you how much was actually paid throughout the year. So think about it. You have the beginning balance of $10,000. You end with $8,000. So at the very least, you paid off $2,000 of that payable with cash. So that's a minimum of $2,000 right there. But also, during the year, you had that expense of $35,000. So it would have gone from $10,000 to $45,000, but then you still end at $8,000. So you have to subtract from $45,000 the $8,000, and that gives you $37,000 of cash actually paid for the utilities. So another way to think about it, you basically just add these two together, the beginning and the expense, subtract the ending, and that gives you the amount that was actually paid in cash throughout the year. All right, let's go to the next question. All right, here we are at question 4, and we're now moving on from operating activities to investing activities for cash flow. You are given the following information for GHI Corporation for the year. They purchased new equipment, they had a sale of old equipment, they purchased marketable securities, not trade securities, marketable securities. They received interest, and they paid dividends. So out of this, what is the cash flow for investing activities? Pretty straightforward. this is much easier than the operating activities. All right, the answer is A. There's a negative $40,000, or really, if you think about it, it's a $40,000 cash outflow of investing activities. So let's walk through this. To calculate the cash flow from investing activities, we consider cash inflows and outflows related to long-term assets and investments. So the relevant activities are the things that have to do with purchasing new assets and new investments. So it's the new equipment, the sale of the old equipment, and the purchasing of marketable securities. So you purchased new equipment, which is a long-term asset. That's an outflow of $50,000 cash. And then you have the sale of the old equipment. That's an inflow of $20,000 cash. And then the purchasing of new investments, and again, that's an asset, a long-term asset. That's another outflow of $10,000 cash because you bought a new investment. Again, investing makes a lot more sense than the operating using the indirect method. And the indirect method really only applies to the operating activities, by the way. You don't have to do that weird, opposite of accounts receivable or anything like that for investing activities. It's just the cash going out, the cash going in from long-term assets and investments. The non-relevant items are the interest received. And again, that's part of operating activities, but typically that's included in net income. So if you're doing the indirect method, that's already included in net income, so you don't need to make an adjustment. But again, you also don't need to make an adjustment here in investing activities because it has to do with operating. The payment of dividends, that's a financing activity that we're going to talk about when we get to the financing questions. So total, they have the sale of the old equipment, less the purchase of the new equipment, less the purchase of marketable securities, and that's a $40,000 total cash outflow. So let's do one more question for investing activities to get a little bit more of an idea. All right, here we are at question 5. You are given the following information for JKL Corporation for the year. They have a purchase of a long-term investment, a purchase of treasury bills, a sale of equipment, and they received dividends from their investments. Think about this. Which of these have to do with long-term assets and investments? Most of it does, but there might be a curveball thrown in here for you. So if you'd like, go ahead and pause the video to see if you can do this. If not, that's okay. We'll dive into the answer. All right, the answer is A, another $45,000 cash outflow. So very similar to the first one, but a little bit more information here to learn. So again, the purchase of long-term investment in bonds, that's an outflow of cash because you spent money to buy that investment. Then they sold equipment, which again, equipment is typically a long-term asset. So they had an inflow of $15,000 cash from selling that. Now the non-relevant items. This one might have been a little bit confusing or tricky. Treasury bills, that is technically something you bought. It's kind of an investment, but technically it's considered a cash equivalent. So in the end, they were really just spending cash to purchase the cash equivalent. So the cash didn't really change as far as the cash flow statement is concerned. So technically nothing happened there as far as the cash flow statement is concerned. And then receiving dividends, you might have thought, well, this has to do with their investments, so maybe this affects their investing activities. Receiving dividends is actually also, again, a part of operating activities, and that's already included in the net income when you do the indirect method. So total, it really was only the sale of the equipment and the purchase of the long-term investment. Again, investing activities for the cash flow is much more straightforward. It's just long-term assets and investments, the cash that has to do with purchasing and selling those specific things. Let's go to the next question to start learning about financing activities. All right, here is question 6. M&O Corporation made the following transactions during the year. They purchased a new machine for $80,000 with a $20,000 down payment and a note payable for the remaining balance. And they made a principal payment of $10,000 on the note payable during the year. They also issued new shares of common stock, and they paid dividends of $5,000 to their shareholders. So what of this is the cash flow from financing activities? So this is a new activity that we haven't looked at in this video yet. So if you want to try, that's okay. Go ahead and do the calculation. But if not, let's go ahead and look at the answer. All right, here is the answer, A, $35,000. So let's walk through this. Cash flow from financing activities includes transactions related to borrowing and repaying debt, issuing and repurchasing equity, and paying dividends. So basically long-term liabilities and equity. Here's how each transaction affects it. So issuing common stock, you might think, oh, they're giving out common stock, maybe that decreases, but no, actually it's the opposite. Issuing common stock gives them cash. So that's an inflow of $50,000 cash. Principal payment on a note payable, that's $10,000 paying off their long-term liabilities. And then paying dividends, $5,000 cash to the shareholders. Again, that it has to do with equity specifically, so that is an outflow of cash for the financing activities. So overall, the issuance of common stock, the principal payment on the note payable, and the payment of dividends, those all together is a net cash inflow of $35,000. Now, something to think about, you might see this in questions. The down payment of $20,000, that is not included in financing activities. That was cash that straight up paid for a piece of equipment. There wasn't any liability attached to this $20,000 down payment. So this is actually an investing activity, this $20,000 right here. But the note payable, the rest of it, the principal payments on that are financing activities, and then the interest portion on it is operating activities. Because if you've noticed so far, the investing activities have to do with long-term assets and investments. The financing activities have to do with long-term liabilities and equity. So what's left is current assets and current liabilities. And anything that has to do with those is also a part of operating activities. So the interest payments, since those are typically considered a current liability or part of a current liability, that is actually a part of operating cash flow. So only the principal payments is considered financing activities. And again, the down payment is considered an investing activity. And then you have the issuance of stock and the payment of dividends. These directly impact financing cash as they involve transactions with shareholders, which is equity. So again, long-term liabilities and equity is financing. Let's go to the next question. All right, here we are at question 7. PQR Corporation reported the following transactions for the year. They issued bonds payable of $100,000. They purchased land for $50,000. They sold machinery. They paid interest on bonds. They repurchased $10,000 of common stock, and they paid principal on a long-term loan. So what is the net cash flow from financing activities? So from what we've learned before, you probably should be able to pick this out, but there might be a couple things that you might not remember, so that's okay. But again, try to do this yourself, see if you can get the calculation, and when you're ready, come back, we'll look at it together. All right, here's the answer, $85,000. So again, cash flow from financing activities is specifically for long-term liabilities and equity. So issuing the bonds, repurchasing stock, paying off debt, principal, those all have to do with it. So issuing the bonds payable, which is kind of like issuing, which again is kind of a way of getting money. That's an inflow of cash from the bonds. Then there's repurchasing common stock. Now, this is kind of a hidden way of saying they just got treasury stock, which again is them repurchasing their own common stock. So that actually, even though it sounds like they're getting another investment, it actually is considered a part of equity. So that reduces the cash from equity. And then again, they paid principal on the loan, and that's an outflow of cash for the repayment of that debt. So overall, $85,000 of cash inflow. Now let's look at these. The issuing the bonds payable and repurchasing the common stock, those directly affect debt and equity. Now, again, as far as the bonds payable, if you think about it, they are receiving all the cash up front for that payable, and then for the rest of it, it's going to be that long-term liability where they're paying off the principal and things like that. But up front, they receive $100,000 in cash, and then the common stock, that's treasury stock that they repurchased technically. And again, we've talked about the rest of this, payments for land and machinery, that's going to be an investing activity. And then the interest on the bonds, that actually is a part of operating activities. So just remember, financing activities has everything to do with long-term liabilities and equity. Let's do question 8, which is going to be everything all put together. All right, here we are at question 8. STU Corporation had the following transactions during the year. And again, remember, this is everything put together. So they had net income, depreciation expense, increase in accounts receivable, decrease in inventory, increase in accounts payable, purchase equipment for cash, they sold investments for cash, they issued common stock, they paid dividends, they paid interest on long-term debt, and they paid principal on long-term debt. So a lot of stuff happened. Now you need to figure out what the cash flow is from operating activities, investing activities, and financing activities. So overall, how does this all affect the cash flow? Hopefully you've learned most of what you need to know from the previous questions. So go ahead and pause the video, see if you can put this all together to get the right answer. And when you're ready, we'll come back and look at it together. All right, here we are at the answer. The answer is A, operating $170,000, investing a cash outflow of $30,000, and financing a cash inflow of $10,000. So let's go ahead and walk through each of these calculations. So for the operating cash flow, you take the net income, you add the depreciation expense, you subtract the increase in accounts receivable, you add the decrease in inventory, you add the increase in accounts payable, and that gives you $170,000. You might again be thinking about the interest paid. Remember that under the indirect method, since you're starting with net income, interest paid and received is already included in net income, so there's no additional adjustment needed for that. So you end with $170,000 cash inflow for the operating cash. Then the investing activity, that had to do with the long-term assets and investments, so that was the sale of the investments, that's $30,000, and the purchase of new equipment, that's $60,000 outflow. So overall, there's a net cash outflow of $30,000 for the investing activities. And then finally, for the financing cash flow, there's the $40,000 that where you issued stock to get money, and then you had a $10,000 payment on the dividends and a $20,000 payment on the principal on the long-term debt. So those all together give you a $10,000 cash inflow for the financing activities. So again, the most confusing part of all of this, in my opinion, is the operating activities using the indirect method, because you have to remember that certain things are non-cash, so they didn't actually affect cash, and you kind of have to think about it from just the cash perspective. How did this affect cash? Did it affect cash? And so that's where the confusion can come in is, oh, I see an increase in accounts receivable. That must mean that cash increased. But actually it's the opposite, because the income increased, but you didn't actually receive that cash yet. So you have to take that out of the net income to get the correct cash flow. Let's do one more question, and this last question will be the only question I go over about disclosures. We're going to talk about the required disclosures for the statement of cash flow. All right, here we are at question 9. XYZ Corporation is preparing its statement of cash flows for the year end December 31st. As part of this process, the company needs to ensure it includes the appropriate supplemental disclosures. Which of the following items must be disclosed in the supplemental disclosure section of the statement of cash flows? So you probably don't know this, and that's okay. We're going to dive straight into the answer. Which of these is required to be disclosed? All right, the answer is D. It's both A and B, so we'll walk through it. The statement of cash flows requires specific supplemental disclosures. First, it's required that they disclose the total cash amounts paid for interest and income taxes during the period. And that's important because companies want to know how much cash they're actually spending on those things. And then they also have to disclose significant non-cash transactions separately, as they affect the company's financial position but do not involve actual cash flows. And you might think that's a little bit weird, but you have to think these are the investing and financing activities that aren't affecting cash, but they're still really big, so they have to disclose those. And some examples of that might be issuing stock to directly purchase assets or converting bonds directly to stock, where the cash didn't really change or there wasn't really a movement of cash, but it could be such a big transaction that people still need to know about it. Now, cash flow related to discontinued operations is not a required supplemental disclosure. This might even be part of the normal cash flow statement depending on how they want to present it and the nature of the cash flows, but this is not a required supplemental disclosure. So the biggest one that you'll probably notice is the cash paid for interest and income taxes, but just in case, you also need to know that they do have to disclose any significant non-cash investing and financing activities. Okay, we went over a ton in just 9 questions. Before we go any further, we're going to do one more part of the Superfast CPA process called Pillar Topics. Now, the idea behind Pillar Topics is as you're going through the questions to learn the material, you will notice the things that keep popping up, the equations and the calculations that you continually see. This is how you do the indirect method, and you see it over and over again, teaching you how to do it. So you take a moment, write down those things as Pillar Topics so that you know them for later, and so you know them for the exam. Let's go to the Pillar Topics for this video. All right, here are the Pillar Topics. First, let's start with operating activities. So I'm just going to kind of summarize how these all work. Gains are subtracted from net income, and losses are added back to calculate operating cash flow. And again, this is for the indirect method, which is what we were focusing on here. Decreases in current assets and increases in current liabilities are added back, while increases in current assets and decreases in current liabilities are subtracted. Interest received and interest payments are considered part of operating activities, so are dividends received. But when you're using the indirect method, these are already included in net income, so you don't need to do any adjustments. Now for investing activities. Investing activities specifically relate to long-term assets, and that includes the purchase and sale of property, plant, and equipment. When equipment is sold at a gain, the cash inflow includes the carrying amount plus the gain, or essentially the total sales price. So this might be something you see where it's asking what the cash flow is from a gain, and in all reality, when you sell the equipment, the cash flow just has to do with the sales price, just the amount of money they actually received. And this makes sense because they actually received this cash, the sales price, and then there was a gain or a loss, and that went and affected net income. And that's why you have to subtract a gain and add back losses, because those affected the net income when the cash was already recognized in the investing activities. So just think about that. Also, purchasing investments is classified under investing cash flows. For financing activities, these specifically relate to long-term liabilities and equity, including stock issuance and debt transactions. Dividends paid are part of financing activities, and issuing stock is considered a cash inflow in financing. And then finally, just generally, when you purchase cash equivalents such as treasury bills, These do not change cash flow since cash is simply exchanged for another form of cash. The cash, as far as the cash flow statement is concerned, didn't change. Under the indirect method, companies must disclose cash paid for interest and income taxes in supplemental disclosures, as well as any significant non-cash investing and financing activities. So, a lot of information, a lot that you need to know. Again, this is one of the most confusing topics in the CPA exam for FAR. So that's why I wanted to do a much bigger, much more in-depth video teaching you about each type of activity for the indirect method. But that is it. That is the end of the video. And before you go, make sure you check out our free 1-hour webinar training on superfastcpa.com. We will teach you the key ingredients to passing the CPA exam. And again, it is only 1 hour. It is free, and we will show you how to pass the CPA exams without wasting months or even years of your time. Also, if you liked going through these 9 questions with me, just remember that Superfast CPA members will have access to the full 18-question video when we post it in the members forum, so you can get more of this by becoming a Superfast CPA member. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.